Right, so as you know, we are learning about cost, volume, profit analysis today. CVP for short, because it's kind of hard to say cost, volume, profit all the time. So CVP analysis is as it sounds. It's when you can analyze a company's performance, its profitability, let's say, based on changes in cost, changes in volume of how much it produces and sells, and changes in price. Okay, so that's what we will be focusing on this chapter. We'll learn a term. This is a really important term we're going to use a lot, not only in this chapter, but in future chapters, you'll see it as well. Contribution margin. Now that contribution margin concept has three varieties. You can apply it on a per unit basis, on a total basis, and as a ratio. Okay, so just like variable costs and fixed costs, remember there was the total fixed costs and the fixed cost per unit. Same thing with the variable cost. We have total variable costs and variable cost per unit. We have contribution margin and contribution margin per unit. And we also have a contribution margin ratio. Okay, so those will be terms you'll get very familiar with. They help us to determine the break-even point. That is the point at which the company's investment has paid itself back. Okay, and you can measure that break-even point in terms of how many units you need to sell to break even, or how much sales revenue you need to earn to break even. So we'll learn the formulas for that. Then we'll be able to apply an analysis based on changes in cost, volume, and price. And so we'll see how changes in cost, volume, and price impact profitability. And that's called a sensitivity analysis because it tells us how sensitive the profits are to those changes. We will learn to do that with a single product, which is hard enough, but most companies don't sell just a single product, right? Most companies have multiple products. So if you're trying to look at changes in cost, volume, or price, or multiple products at the same time, that gets kind of complicated. But there's a trick. There is something called what is it called? Composite unit. That was the word I was looking for. Composite unit. Somebody mentioned it earlier today. That is the trick. You can use a composite unit to measure the impact of changes in price, cost, and volume on multiple products at the same time. It's a multi-step process. You're going to want to take really good notes because of all the steps involved. But if you follow the steps, it works really well, and it's actually much easier than trying to analyze multiple products separately. We combine them into one composite unit. Okay, so we'll get to that a little bit later, which allows us to do a multi-product analysis. We will also learn these concepts, margin of safety and operating leverage. They're not that complicated. Margin of safety means basically how much more you sold over your break-even point. And operating leverage has to do with how much of your costs are fixed costs versus variable costs. And this is an important concept because when you have high fixed costs, it's hard to reach that break-even point, but once you do, you can become much more profitable. So that's why large companies that have a lot of fixed costs are so profitable, because once they cover those fixed costs, their variable costs per unit are small. And the more they sell, the more profit they make. So we will get into all these concepts. If it's already feeling overwhelming, don't worry, we're going to take them one at a time, try to make sure everything is clear. But that's just an overview of what we'll be covering this week. All right? Questions or comments at this point? Okay. All right, so I told you contribution margin is a really important concept. How you calculate contribution margin is very simple. As it says here, you take your sales, which would be your sales revenue, subtract your variable costs, and you get your contribution margin. Okay? The reason this is important, we know that variable costs increase with production, right? And we know that the more we sell, the more revenue we generate. So what this tells us is what is the difference between those two? If we take the total amount that we sold and we take out the variable costs, how much are we contributing to covering our fixed costs and making a profit? Okay, so that's why it's called the contribution margin, because it tells us how much money we are contributing to those two things, covering the fixed costs. And once you cover the fixed costs, how much are we contributing to profits? Okay. Now, I mentioned that it comes in 3 different varieties. So we have the total contribution margin based on the formula we already saw. This is a contribution margin per unit formula, and it's actually the same concept. When we looked at total, it was the contribution margin is equal to the sales minus the variable costs, right? And if we do it on a per unit basis, we see the contribution margin per unit is equal to the sales price per unit minus the variable cost per unit. So the only difference between this formula and the last one is we just put the words per unit after everything. Okay, you see that relationship? Contribution margin per unit is your sales price per unit minus your variable cost per unit. All right, here's an example. So this company makes these bird houses, and every unit they sell for $100. Okay, I guess there are people out there that are willing to pay $100 for a birdhouse. And their variable cost for every unit that they produce is $20. So following that formula we just saw, we're going to take our sales price per unit, subtract the variable cost per unit, and the difference is the contribution margin per unit. That means every birdhouse they sell is contributing $80 towards their fixed costs. And after they've covered their fixed costs, now they're making a profit. Right? So that $80 is going towards either fixed costs or profits. For those who just came in, if you didn't, make sure you put your name on the list. Okay. Did you do, Gary? Did you do that?
Yeah.
You did? Okay. So put your name on the list.
Oh, yeah.
Okay. Yeah, you're fast. I didn't see you do it. Okay. So does that make sense? Okay.
Mr. Williams.
Yes.
So does that mean that the contribution margin, does that like entirely go to the fixed cost or the profit, or are there like exceptions?
It all goes. So this whole $80 is going towards covering the fixed costs. Once they're covered, then anything left over is going towards profit. Yep. Okay. So I mentioned to you that there's total contribution margin, sometimes just referred to as contribution margin. There's contribution margin per unit, and there's also a contribution margin ratio. Okay. The contribution margin ratio is also a pretty simple formula. We take the contribution margin per unit and divide it by the sales price per unit. So in that example we saw with the birdhouses, we would take an $80 contribution margin per unit. Remember this $80. We would divide it by the sales price per unit. And in this case, we get 0.8. Or what's another way to say 0.8? 80%. Okay. So out of every birdhouse they sell, 80% of that sales revenue is going towards fixed cost or profit. Now, for those who are good at thinking mathematically and algebraically, if we were to just say contribution margin divided by sales, would it be the same ratio? If we took the total sales of all of the birdhouses that the company sold and divided it into the total contribution margin of all the birdhouses, guess what? We would get the exact same ratio. So you could either do it like this, contribution margin per unit divided by sales price per unit, or just contribution margin divided by sales. Either way, it's going to be the same ratio. Okay? What questions are out there? Huh? All right, moving on then. So here we see a contribution margin income statement. We're familiar with income statements, right? So all we're doing here is subtracting out the variable costs of production so that we can know our contribution margin. Now, you would never use this in financial accounting. It's not for distribution outside of the company. It's only for the managers in the company, okay? So it's an income statement that would help managers who want to see a breakdown of how much of the costs are variable and how much are fixed. So for this company, if they sell 500 of their birdhouses at $100 each, that would be $50,000 of sales revenue. Okay. Now, the variable cost for those same 500 units multiplied by $20 per unit comes out to $10,000 of variable cost. And so now we can see the contribution margin, $40,000. To get to our net income, or in this case, they're calling it operating income, we have to take out the fixed costs. So we subtract contribution margin minus fixed costs to get our operating income. So this gives us a little bit more insight to the normal income statement because it tells us how much of the costs are fixed and how much are variable. If you are a production manager, would it be useful to know how much of your costs are fixed and how much are variable? Which do you think you have more control over? Fixed or variable? Which can you control more?
Variable.
Probably the variable, right? Because variable costs are made up of what? Well, we multiply the variable cost per unit by the number of units, but what goes into the variable cost? There are three manufacturing costs we've talked about, right? Okay, so we've got our direct material costs, and managers would have some influence over those costs. We have our direct labor costs. You have some control over that because you decide who you're hiring and how much they're going to get paid. And overhead, yeah, overhead includes all the indirect material and labor and other manufacturing costs, right? So those are the things managers have more control over, their variable costs. The fixed costs, things like rent, insurance, supervisor salaries, those are a little harder to control if you are a frontline or middle level manager. So it would be useful for them to know how it breaks down between the variable and the fixed costs, and they can really try to get their variable costs down as much as possible without sacrificing quality. So it would be useful to have a contribution margin income statement. All right. Anything need clarification at this point? Any questions? No, all right. So here's an example. Okay, you have a kiosk in the mall that you're renting for $300 a month, selling t-shirts. The t-shirts sell for $25 each. Okay, so that's the sales price. What we see here, if we were to sell 100 t-shirts times $25 each, that's $2,500 in sales revenue, right? And 200 t-shirts at $25 each would be $5,000 in sales revenue. Okay. Now, if our variable costs include a $15 cost per t-shirt plus a 50-cent commission we have to pay to the salesperson, that's $15.50 of variable cost, right? In this case, we've got production costs for the material, the t-shirt, and also we're throwing in some commission sales costs. That is a cost, it's variable, it's not part of production, but we are going to go ahead and include variable sales costs, okay? So we have a total $15.50 per shirt. Now, times 100 shirts, that's $1,550 of variable costs, times 200 shirts, $3,100. So then how do we calculate contribution margin here? What's the formula? Okay, exactly. Alexandra, was that you? Yeah, exactly. We take the sales minus the variable costs, and we get the contribution margin. Very simple, right? Then we take out the fixed costs, and notice that the fixed costs stay the same, regardless of the production. And that's made up of $400 salary that we have to pay to the employee and $300 to rent the kiosk. So regardless of how many t-shirts we sell, we have those $700 in costs. We subtract that out and we get our operating income. Now, isn't it interesting, by doubling the number of shirts that we sell, we go from only a $250 operating income to almost $1,000 more, $1,200. Because again, once you cover your fixed costs, your contribution margin is going just to profits. So here they're just barely covering their fixed costs and eking out a little bit of profit. But once you cover those fixed costs, every unit you sell is contributing towards your profits. Okay? Any questions or comments?
Jordan, so the fixed costs would include like labor and stuff, expenses, and the profit is just actually like money to distribute, like for profit.
Well, hourly labor would be variable, right? But if you're paying a salary, that would be fixed, right? So that's why you have to separate costs into those categories to know what would go into here would be direct material, direct labor, and overhead. Well, take that back. Direct material, direct labor, and variable overhead, because there is some fixed overhead. And then the fixed overhead would be your fixed costs. Okay. All right, so if you did not have an income statement like this one, okay, and you needed to find out what your contribution margin is, well, here's an alternate way, and you can imagine this is going to be somewhere on the exercise set or problem set. You'll have to use this formula. You can find out your contribution margin by taking your total sales and multiplying that by your contribution margin ratio. Here's an example. If the company had $75,000 in sales for the month of May, and their contribution margin ratio was 80%, meaning that 80% of their sales are going towards fixed costs and profit, then we can determine what the contribution margin is, $60,000. right? 80% of sales equals 60,000. So that is a formula that might come in handy, right? Finding units sold using contribution margin. This is going to be very handy. We'll use this quite a bit. If you know your total contribution margin and you know the contribution margin per unit, then you can figure out how many units you sold by simply dividing. So we see here, the company had a contribution margin of $40,000. Every unit had a contribution margin per unit of $80. And so we just divide and we see, well, then we sold 500 units. Okay? Understanding these relationships is really helpful because then you also know you could take your number of units times your contribution margin per unit to get your total contribution margin. Go either way. Okay. Don't expect you to memorize it all today, but do take good notes. And as we go through, you'll be referring back to these formulas as needed. Okay. Any questions? Okay, then here's another example. Which one is this? Oh, yes. So we have 2 orders we can accept from customers, but we can only accept one or the other. So we have to decide which one we should do. And they're different. Customer A wants 500 units. They'll pay $200 each. And the contribution margin is $60 per unit. So let's start with that. If we take 500 units times $200 each, that's $100,000 in sales revenue. Not bad, right? And if the contribution margin is $60 per unit, we can multiply that by the 500 units and see that would give us a total contribution margin of $30,000. And then if we wanted to know our variable costs, we could simply say sales minus contribution equals variable costs. Just like sales minus variable costs equals contribution margin, right? That's another formula you can use both ways. But for right now, we're more concerned with contribution margin. All right, so we could sell $100,000 to customer A and have a $30,000 contribution margin. On the other hand, if we go with customer B, they want 1,000 units, so we're gonna have to produce twice as much. They're willing to pay only 140, so they're not, paying the 200 that we're getting from customer A. But here the contribution margin is 40%. They gave it to us as a ratio. Right, well, let's do the math here. 1,000 units at $140 each is $140,000, right, of sales revenue. Then 40% of that, we just multiply the 40% times the sales revenue and we get the contribution margin. So it's more work, but if we go with customer B, that's going to contribute more towards our fixed costs or profit. So looking at it from that perspective, we would go with $56,000, right? If our goal is to get as much money as we can to cover our fixed costs or make a profit, we would go with the one with the higher contribution margin. Again, it's going to be twice as much work. So some managers might not want to go that route. But if the goal is contribution margin, it's clear this one would be better. Okay? So that's how you would apply all this abstract information to a concrete situation and make a decision. All right, any questions on that? Did I say something? Do I have to separate you two? All right, so let's talk about break-even points. Right, that's the point where you break even, where whatever you invested as a company, you've gotten back. You don't have a profit, you don't have a loss, you broke even. Okay? Beyond that, Beyond your break-even point, that's where you start to make a profit. So here is one way to define the break-even point. It's where your sales, revenue from sales, equals your total costs. So you sold $100,000 worth of product and your costs were $100,000, you've broken even. Okay? There's an alternate way to define break even. If you want to write it down now, it wouldn't be a bad idea. Break even is also the point where your fixed costs equal your contribution margin. Okay? Correct. So let's say the company had $60,000 in fixed costs and $60,000 in contribution margin. Well, that contribution margin has now covered their fixed costs. Again, they haven't made a profit, they've broken even. Okay? So two alternate formulas, but they would both apply at the same time for the same company. Okay, so in trying to communicate your break-even point, you can communicate it in number of units that you would have to produce or sales revenue you would have to earn. Okay, and we'll learn the formula for each of those after we talk about Starbucks. Okay. So let's think about this CVP analysis, right? Cost, volume, profit analysis, where we're looking at changes in cost, changes in volume, changes in price, and how that impacts company profits. Didn't last week we talked about how Starbucks or coffee shops have different costs and different revenue sources, right? So can you imagine at a Starbucks how many different costs they have, the large volume of sales that they do, all the different prices on all those different products? How do you decide what those prices should be, right? I mean, that's a marketing decision, but marketing would need information from accounting because you need to take into account the costs. If your cost for a cup of coffee are higher than your price for a cup of coffee, you're losing money, right? And typically companies don't want to do that. Sometimes they will take a loss on a certain product in order to get customers in the door. But generally you want your prices to be higher than your costs. So for every possible product and every variation, mocha, grande, latte, with oat milk, or whatever the combination is, somebody has to know what are the costs so they can set the right price, right? And that's why they charge you extra for oat milk, because it increases their costs. So a company like Starbucks would be able to use this. And again, you can apply these techniques individually for individual products or collectively for a group of products. All right, so break even. Companies generally want to make a profit, right? But first you have to break even before you start making a profit. So here we see a visual representation of the break-even point. I'll walk you through it. Okay, so for those who relate well to visual information, hopefully this will make a lot of sense. On the x-axis here, we have the number of units that the company sold, right? And just think about one product. So how many units of product they sold and the total price, or I should say total sales and the total costs, okay, are on this price axis here, this dollar axis. So let's start with the revenue line. If you sold 0 units, you have 0 revenue, right? And the more units you sell, the more revenue you earn, right? So this is your total revenue on this line. Now, the other line that starts here is your costs. Notice that even if you sell 0 units, you already have some costs. Why would that be?
Because whatever you sell has a cost.
Whatever you sell is a cost. What was that? Right? Right? But remember fixed versus variable? You got fixed costs even if you sell 0 units, right? So right off the bat, you've got these fixed costs. And then the more you sell, the more variable costs you're going to have. And that's why this line goes up. So this is your total cost, fixed plus variable. Keeps going up the more you sell until you get to this break-even point, right? At that point, your total costs equal your total sales revenue. Or your fixed costs equal your contribution margin. And you have broken even. But that cost line keeps going, right? Even past the break-even point, the more you sell, the more costs you're going to have because of those variable costs. So what happens is in this, that teal, I don't know what color that is, I'll just say green area. If you're in that green area, you're losing money because you didn't break even. If you're in this orangish color up here, you're in the profit zone because you passed that break-even point and you're now earning a profit, right? The more you sell, the more profit you make. So this is why it's very important to know where that break-even point is. Okay, any clarification needed here? We'll see a couple variations of this chart, but this is the basic one. So going back to our birdhouse company. Here we see their sales price per unit, again, $100. Variable cost per unit was 20. Contribution margin was 80, right? We saw that earlier. The question is, what is the break-even point for this company? Now, to calculate that is really very simple. Does anybody know how we would find the break-even in units for a company? Oh, go ahead, Christina. Right, Christina?
Yes.
Yeah.
I think you divide the 50,000 and 80.
Okay. Divide the $18,000 by the 80. Okay. And is that what you're going to say, Emma? Sure. Yeah. What she said. Yes, that is correct. We take the total fixed costs, divide it by the contribution margin per unit, and that will tell us how many units we need to sell in order to break even. So having that information, that contribution margin per unit, is really useful because you need it to figure out your break-even point. So this is the formula. Take the total fixed costs, in this case that was 18,000, divided by the contribution margin per unit, that was $80. And we see we need 225 units sold to reach that break-even point. Everything after that is gravy, as they say, profit. Okay? So it's not that hard, right? It's a very simple formula. Any questions? All right, so if we did sell those 225 units, what would our contribution margin income statement look like? Well, 225 units times $100. Okay, ignore this typo here. It should be per birdhouse. So 225 birdhouses at $100 each would be this much sales revenue. The same number of birdhouses at $20 each in variable costs would be this much in variable costs. We subtract the variable cost from the sales, and we get our contribution margin. And notice that our contribution margin equals our fixed costs, which means we are at break even. We have no profit, no loss. So like I told you earlier, when our contribution margin equals our fixed costs, that is our break-even point. Okay? And in this case, you see our total sales also equals our total costs. Both are true. All right, how we doing? Hanging in there? All right. Okay, so let's see what it looks like here. If we sold 225 units, that brings us to this point on the line, 22,500 in sales revenue. Again, that is the point at which this company broke even, right? So it's a visual illustration of what we just saw. All right, what if they sold only 175 units? What do you think? Would that be a profit or a loss?
A lot.
A loss, because they need 225 and they only sold 175, right? So there are two ways we could look at this. We could make an income statement like this and say 175 units at the normal sales price minus 175 units at the variable cost per unit gives us $14,000 contribution margin. We subtract the fixed costs, we see we now have a loss of $4,000, right? Another way we could look at it, since we knew we needed 225 units to break even, and we only sold 175, we were 50 units short. If you take the number of units that you're short and you multiply it by your contribution margin per unit, guess what? It comes out to the same $4,000 loss. Okay, so either formula would work here and show you what your total loss would be. Okay. So let's look at that. Again, this is if they only sold 175 units. Now we're in this green territory, right? So we've lost money. And our total sales revenue is 17,500. Obviously, we didn't get up to the break-even point. On the other hand, what if we sold more? What if we sold 300 units? And now we're looking at a $30,000 sales revenue minus $6,000 in variable costs. We have a $24,000 contribution margin. Once we subtract our fixed costs, we have profit, right? Or again, we can look at it in terms of units. The difference between the 225 we needed for break even and the 300 we sold was we sold 75 more, right? Multiply those 75 additional units times the contribution margin per unit of $80, and we see we made a $6,000 profit. Then we can see what that looks like. So now 300 units were way over here. We're up in the orange territory, right? We're making a profit. Is this making sense? You seeing the relationships here? A lot of what we do has to do with relationships between this number and that number and how it impacts another number. Okay, so I told you how to find break even in units, right? I said that if you take your fixed costs and you divide it by the contribution margin per unit, then you know how many units you need to produce to break even. Well, what if you want to know your break even in dollars? In other words, how much in sales revenue do you need to break even? Well, there's a different formula. We could take our fixed costs and divide it by our contribution margin ratio. Do you remember how this company had an 80% contribution margin ratio? How did we come up with that? Emma? The what by the what? It's the contribution margin per unit divided by the sales price per unit, or the contribution margin divided by the sales. Either variation is going to get you, for this company, the same 80%. And then you divide that into your fixed costs. And that will tell you the dollar amount in sales you need in order to break even. Okay? To me, there's an easier way. And there will be times we have to do it this way. So you have to first figure out your contribution margin ratio, and then you can divide it into your fixed costs. What would be an easier way to get to this number, though? The sales revenue to break even. Christina, you told us earlier how many units we needed to break even, right? You said it was 225 units. And remember that each unit sells for $100 each. You just take the number of units that you need to break even, multiply that by the sales price per unit, you get that same number. A lot of times that's a shortcut you can take, okay? Like many things in this chapter, there are two different ways to do things, depending on which is easier. Take the path of least resistance. Well, there will be times where you have to understand this approach. Yeah, for the exercise sets and problem sets, and maybe in real life, there might be times where you happen to know the contribution margin ratio, and you can impress your boss because you can quickly divide that into fixed costs and tell them the dollar sales you need to break even. Right? I mean, really, you might need to do that. I've been in meetings with business people and they're tossing numbers around. Keeping up with what they're saying and being able to see the relationships in your head is really important. So yeah, there might be times you need to use this. All right. Everybody still with me? Any questions at this point? I'm sure somebody's got a question. You scan the room and see who looks like they have a question. All right, I don't see any questions out there. Okay. This is a helpful slide you'll find in this PowerPoint. It has 5 different formulas that will be useful to you. And remember, some of these have variations, so let's take a look at them one at a time. To find your contribution margin, you can take your sales minus your variable costs, right? And if you want your contribution margin per unit, what would you do? The contribution margin equals sales minus variable costs. Contribution margin per unit equals
Per unit sale price minus variable cost per
the
unit.
sales price per unit minus the variable cost per unit. So you're really just sticking the words per unit after each of these terms. Okay. Then we have the contribution margin ratio. Take contribution margin per unit divided by sales price per unit. Like we said with the birdhouse, it was $80 divided by $100, and that's how we got the 80%. Right? Well, what would be a variation on this formula? How else could you come up with the contribution margin ratio? Instead of contribution margin per unit divided by sales price per unit.
Contribution margin over.
Exactly. Don't say contribution margin divided by your sales. And it gets you the same ratio. Break-even point is sales. Well, it says sales minus total costs equals 0, which is another way of saying your sales equals your total costs. What was the variation I told you on this formula? Thank you. Also, Christina, right? Fixed costs equals contribution margin is also your break-even point. Then to get your break-even point in units, we can take total fixed costs divided by contribution margin per unit. To get your break-even in dollars, we take our fixed costs divided by your contribution margin ratio. Right? So this slide, having it handy, will probably be really useful because you can access 5 different formulas here at a glance. Right, anything clarification? So let's practice here. This company makes blankets for dorm room beds and lofts, I think it says. The selling price of each blanket is $80 and the variable cost per blanket are $48. And we see the fixed costs. So starting off with kind of a tough question here. What is the break-even point both in units and dollars? Let's start with just break-even in units. Okay, we just saw that formula, right? Break-even in units is your total fixed costs divided by your contribution margin per unit. Okay, that's not so scary. Total fixed costs, 4,000, divided by contribution margin per unit. What is the contribution margin per unit for this company?
32.
32. How did you get that?
80 minus 48.
Okay, so we took the $80 sales price minus the $48 variable cost, and Jordan got $32 as the contribution margin per unit. So we simply then take our break even of 4,000, divide it by $32 contribution margin per unit, and that tells us we need 125 units to break even. All right. So the trick is just remembering what's what, right? The formulas are simple. You just have to remember what goes where, and you can do your calculation. Then break even in dollars, that formula was fixed cost divided by contribution margin ratio. Or again, we could kind of cheat on that one. We could just take the 125 units that we know we need to produce, multiply that by the $80 sales price. Is that right? Yeah. Yeah, here it is, 125 units times $80 sales price. That would be $10,000 in sales revenue we would need to break even, right? But if we wanted to do it the harder way, we would need to know our contribution margin ratio so we could divide that into our fixed costs. So how do we get our contribution margin ratio? Well, Jordan told us already our contribution margin is $32. We would divide that by our sales price. I'm sorry, our contribution margin per unit is $32. We would divide that by our sales price per unit, and we would get a contribution margin ratio of 40%. That 40% we divide into the fixed cost of $4,000. You see here, $4,000 divided by 40%. We get that same $10,000 sales revenue to break even that we would have gotten here by cheating, right? Both of them get us the same answer.
Or does the contribution margin ratio always relate to contribution margin like that? Like how it's just 4,000 and then 140?
Say it again.
Because the contribution margin is 4,000 and the ratio is 0.40. Is it always just like dividing it by that much, or is it just like that for this one?
Oh, yeah, it's just, yeah. So it just happens that this is 4,000 and this is 0.4. That's just coincidence. Okay. All right. Any questions? Let's look at part B. Present the contribution margin income statement at break even. Okay, so let's make a contribution margin income statement at break even. We said that for break even, we need 125 units or $10,000 in sales revenue, right? So that's where we would start, $10,000 in sales revenue. And then that same 125 units we need to break even times our variable cost per unit of $48. So we see that that is $6,000 in variable costs. By the way, you're not going to find these answers in the textbook, so feel free to jot them down or take a picture if you want for reference. Now that we have our variable costs, we can subtract that from our total sales. That gives us our contribution margin of 4,000. And because that equals the fixed cost of 4,000, we see that we are indeed at our break-even point. Not our breaking point, right? Our break-even point. You might be at the breaking point, right? But that's a different concept. That's psyche class, not accounting. All right. So here we've made a contribution margin income statement based on being at break-even. Any questions there? All right, let's see what part C is. If Cindy Lou sells 150 blankets, what will be her income? Okay. Well, we could figure that out different ways. We know contribution margin per income, per unit, right? We know she needs 125 just to break even. So this is selling 25 more than that. So we know she's going to be in the profit territory. So if we made a contribution margin income statement, we would take the 150 units times the sales price to get the sales revenue. 150 units times the variable cost per unit to get the variable costs. That leaves her a contribution margin of $4,800. Subtract out the fixed costs and you see she's made a profit of $800, right? That would be one way to approach it. An easier way might be to say, okay, she sold 150 units, which was 25 more than she needed to break even. You could multiply that 25 by the contribution margin per unit and get the same $800 profit, right? Both approaches work. All right, let's look at D. If she has a contribution margin of $6,400, how many blankets did she sell? Okay, so for total contribution margin of $64,000, how can we figure out how many blankets that would be?
Oh, 300. Wait, 200.
So we said that the contribution margin per unit was $32, right? By taking the variable, the sales price minus the variable cost. That gave us a contribution margin per unit of $32. And then how did you get that number, Jordan?
32 times 2 is 64.
Okay, so if we took the total contribution margin and divided it by the contribution margin per unit, then Jordan is right. Total contribution margin divided by contribution margin per unit, that tells us she must have sold 200 units to get that contribution margin. Okay. And the last part, what if her fixed costs became 4,640 instead of the original 4,000? How many additional units will she need to sell to break even? How can we figure this out? You know she needed 125 to break even before at a $4,000 fixed cost. But if her fixed costs go up by $640, how many extra blankets does she need to sell? Anybody want to take a stab, Jordan?
You divide the difference in the fixed costs by the contribution margin per unit.
Very
It's
good.
20.
Very good. You could divide that difference in fixed costs by the contribution margin per unit, and that would tell you how many extra units. As we go through this class, the phrases we use keep getting longer and longer and longer and harder to say. So here is not the way it was calculated, but that does work. If you took that $640 increase and divided it by $32 per unit, it would equal 20. Here they took the total fixed costs divided by the contribution margin per unit to get 145 units, but subtract out the original 125 for break even, and that also gets you 20. So either way gives you the same result. He just took the difference in fixed costs, just the $640 that it's going up, and divided by 32 to get 20, which is easier, I think. So that would be my preferred method as well, instead of doing all this. Okay. Still awake? Good. All right. Here's a new concept. This one I think is pretty easy because it's just a variation on what you've already learned. Companies don't want to just break even, right? I don't know any company out there that's like, we just want to break even. You know? We don't care about profit. We just don't want to lose money. No, companies want to make a profit. Even if they're nonprofit, they still want to make more than break even because then they can put that money back into their company. So how would you calculate how to reach a certain level of profit? Actually pretty easy. If you have a certain target profit, you just add that amount to your fixed costs and then divide by your contribution margin per unit. So it's really the same formula we saw before. Remember, to figure out how many units you need to break even, we said fixed costs divided by contribution margin per unit. So to figure out how many units you need to reach a certain level of profit, you just take your fixed costs plus that desired profit and then divide by your contribution margin per unit. It's just one extra step. And the same thing with, if you're trying to figure out your sales revenue that you would need to reach a certain amount of profit, take fixed costs plus that desired profit and divide it by your contribution margin ratio. The same formula we saw before, we're just adding that target profit to the fixed costs. Okay? Let's see an example. If this company has $18,000 in fixed costs, but they want to make a $16,000 profit, you just add those two numbers together. Divide it by their contribution margin per unit, and you see how many units they need to produce and sell to reach that target profit. Same thing down here. Fixed costs plus desired profit divided by your contribution margin ratio. You see the sales revenue needed to reach that desired profit. And then if you make your contribution margin income statement down here, we take those 425 units that we needed to reach that profit, multiply by the sales price to get our total sales revenue. 425 units times our variable cost per unit to get our total variable costs. Subtract to get the contribution margin, right? Then take out the fixed costs and you see we have that target profit. So it's really not that different from what we've already done. Thank goodness, right? Any questions out there? Okay. So this has not been taxed, right? This is the profit, and companies have to pay taxes on their profits. So what if your boss came to you and says, how many units do we need to sell to reach a certain after-tax profit? Great. We have the formula for pre-tax profit. We have a formula for after-tax profit. So there's an extra step you need to take to figure out after-tax profit. What you're going to do, take the amount that your boss told you, whatever is the after-tax profit that the company wants, divide that by the number one minus the company's tax bracket, which for corporations now, it's basically 21%. So that makes it a little bit simple. So we would, for corporation today, we would take the after-tax profit, divide it by 1 minus 21%. Well, 1 minus 0.21. The reasoning here, if you had $1 of profit and you had to pay 21% tax on that, well, you could take the dollar, subtract 21%, 21 cents, and that would leave you with 79 cents of after-tax profit, right? So that's what we're doing. 1 minus the tax rate tells us how much money we'll have after taxes. Okay, any question there? So I think we have an example. We do. Here they're using a tax rate of 40%. I don't know that that was even true when the textbook was created. I don't remember corporate tax rates going up that high, but anyways, let's just go with it because that's what the example says. So if your boss says, you know, we want a $24,000 after-tax profit, now you need to convert that into a pre-tax profit so that you can figure out how many units you need to produce. You would take that $24,000 that your boss told you, after-tax profit, divide it by 1 minus 0.4. What's another way of saying 1 minus 0.4? 0.6, right? You can try that on a calculator and you'll get 0.6. So in other words, we're saying $24,000 divided by 0.6 gives us 40,000. That would be the pre-tax profit we need to earn in order to be left with the 24,000 after tax, if we have a 40% tax rate. So now that we've converted the after tax into the pre-tax, we could take that 40,000 pre-tax amount, add it to our fixed costs, divide it by our contribution margin per unit, and we know how many units we need to make and sell in order to reach that desired after-tax profit. Or fixed costs plus the pre-tax profit we calculated divided by our contribution margin ratio tells us what sales revenue we need to reach that desired after-tax profit. Okay, and then we can see that in a contribution margin income statement over here. We said 725 units need to be sold. Multiply that by the sales price to get our total sales revenue. Multiply the number of units times the variable cost per unit to get our total variable costs. Subtract to get the contribution margin. Subtract the fixed costs to get our pre-tax profit. Then 40%, because that is the tax bracket in this example. So 40% of that pre-tax profit would be $16,000 of taxes. Subtract that, and we're left with 24,000 after tax. Okay, so when you know the formulas and how to apply them, it's really not that hard. It's just getting used to the terminology and what is what, right? Remembering what number goes where. All right, anything need clarification? Okay, let's keep going then. Let's see. Okay, what is the break even in units and dollars in this situation? So we know the company's fixed costs are $14,000. We know that the sales price per tax return that this company provides is $400. So that is their sales price per unit. Their variable cost per unit is $150. What would be the contribution margin per unit in this example? $250, exactly. We take sales price per unit minus variable cost per unit, and we get $250 contribution margin per unit. So we're being asked to do several things here. Figure out break even in units, figure out break even in dollars, make a contribution margin income statement showing the break even point of 0, right? Your break even means your net income or operating income is 0. Then, what if we wanted a pre-tax operating profit of $10,000? So pre-tax We don't have to do the after-tax stuff that I just showed you. This is just pre-tax. So how many units and sales dollars would we need in order to reach that desired pre-tax profit? And then what would the contribution margin income statement look like at that profit? Think you can do that? Let's find out. Let's start with just the first two. Okay, see if you can figure out break even in units, break even in dollars, and make a contribution margin income statement at break even. Okay, so work together, help each other out. Okay, kind of like group therapy session, and see how much you can get done. Okay, and if you finish that and want to move on, go ahead.
The first one?
Yeah, yeah, for
Okay,
break even.
the
So
first thing we have to figure out is break even in units, right? How do we do that? Break even in units, what's the formula?
divided by your contribution margin.
Fixed cost divided by contribution margin per unit. We know the fixed costs, right? What is our contribution margin per unit?
250.
250, right? They didn't give that to us, so we had to take the sales price per unit minus the variable cost per unit to get that $250 contribution margin per unit. Then we can divide that into our fixed costs. Fixed costs divided by contribution margin per unit. We need 56 returns to break even. How many people got that? 56? Okay, good, good. All right, let me get everybody's attention. Y'all, excuse me, hello. Welcome to class. Let's stay together here for another 20 minutes. So if we take that 56 units that we need in order to break even, we could just multiply that by $400 and we would know the total sales revenue, right? Or if we wanted to do it the other harder way, we would take our fixed costs and divide by our contribution margin ratio and get the same thing. How would we figure out our contribution margin ratio? Where does this?
Contribution margin per unit divided by sales per unit.
Divided by 400, yes, the contribution margin divided by the sales price. Well, let me rephrase that. The contribution margin per unit divided by the sales price per unit, right? So in other words, that $250 that we calculated divided by the sales price gives us this 0.625. And I know some folks rounded, but you really don't have to round with a short number like that. So it's better to just use the 0.625, divide that into 14,000, and that will give you the total sales revenue you need to break even. Same thing as if we took 56 returns multiplied by 400, we would get that 22,400. Any questions on that part? So then if we want to make our contribution margin income statement, we just take that information, the 56 returns we need, times the price per return. We get our total sales revenue, which you notice is the same we just calculated, right? Variable cost for 56 returns times the, what was it, $150 each, gets us our total variable cost. How do we then get our contribution margin? Track, right? Then we take out the fixed costs and we confirm, yes, we are at break even. Not that hard, right? A little confusing maybe. Now let's say we wanted to figure out how many units we need to sell and how much revenue we need to earn to reach a $10,000 profit. really the same thing. Same formulas. We're just going to add that $10,000 to the fixed costs. Right? So we're going to take the fixed cost plus $10,000, divide it by contribution margin per unit, and you see we now need 96 returns. You multiply that 96 returns by the sales price of $400 to get a total sales revenue, or fixed cost plus $10,000 divided by that 0.625 contribution margin ratio that we already calculated. Right? Now we can take that amount of sales revenue, the variable cost for 96 units, we subtract that, we get our new contribution margin, subtract our fixed costs. We know we get that $10,000 desired profit that our boss was looking for. So pretty much the same thing, right? We just added the desired profit to the fixed costs. All right, does anyone have questions? Comments? Okay, we're making really good progress. We've covered a lot. Jahira,
Okay, quick question. So how did you get the contribution margin ratio again?
we took the contribution margin per unit and divided by the sales price per unit. So in other words, the $250 that was the difference between sales price and variable cost per unit was $250 divided that 250 by $400 sales price. Okay. The contribution margin ratio is your contribution margin per unit divided by your sales price per unit. Or contribution margin divided by sales will give you the same ratio. All right, so we covered that, right? Yes, we covered that. Okay, here's another hypothetical. Let's we can go through this one together. This one, you might be able to do some of the math in your head, or we'll see. So this company makes lofts for $500 sales price, and their variable cost is $300. I don't know how you make a loft for $300, but their fixed costs are $100,000. Right? So based on that information, first thing we want to figure out, what happens if this company does not produce any lofts? What's going to happen financially? They're in debt. Well, maybe not. They might have funded it out of their savings or something. But in terms of profits, how are they doing?
Minus 100,000. Right?
They're minus 100,000, right? They have a loss of 100,000 because they had zero revenue and $100,000 of fixed costs they had to cover, right? So they have a loss of 100,000. Okay, what if they sell one loft? Then what are their financial results?
Minus 99.8 profit.
Yeah, then they've lost $99,800. How did you calculate that, Robert?
You get the contribution margin and just subtract it from your fixed cost.
Okay, so their contribution margin is $200, right? Because they sell each loft for $500 and it costs them $300 in variable costs. So they make $200 on every loft. So they sold one loft, made $200, but they lost $100,000 in fixed costs. If you take that $100,000 minus the $200 from the one loft, and they've only lost $99,800. That's a little bit better, but still not a good business model. What if they produced and sold 501 units?
They would have a profit of $200.
They would have a profit of $200. How'd you figure that out, Alexandra?
Oh, well, I just took the 200 and I multiplied it by 501. And I took that number, subtracted it by the fixed cost.
Exactly. So you take the $200 contribution margin per unit, multiply it by the total number of units they sold, and you get $100,200 of sales revenue. but then we have to subtract out, or actually, I'm sorry. You get $100,200 of contribution margin. And then subtract from that their fixed costs, and that leaves you with a $200 profit. Okay, so yes, that is correct. How many units does the company need to sell in order to break even?
500.
500.
Okay, 500 is right. And we know the formula for that, right? It's fixed costs divided by contribution margin per unit. Right? So $100,000 divided by 200 tells us we need 500 units to break even. How many units would they need to sell if they wanted a profit of $50,000? We figure that out.
Take our fixed cost, and we're gonna add that by our desired pre-tax profit, and we're gonna divide that by our contribution margin per unit.
Exactly. So we take our fixed cost of $100,000 that we need to cover before we break even. We add the desired profit of $50,000. That means we need $150,000 of contribution margin to get to that desired profit. We take that $150,000 of contribution margin divided by the $200 contribution margin per unit. And yes, we would need 750 units per unit. Or you could just take $50,000 divided by $200, and that tells you you need an extra 250 units on top of the 500 you needed for break even. So you could do it either way. All right, so this one, because it has nice round numbers, is not as hard to do. We've got 10 minutes, so let's go ahead and tackle one problem here. Problem number 2. So let me open it up and let's go through it. Oh, this one won't be too bad. I think y'all can handle this. So it's just a normal income statement. It's not even a contribution margin income statement. Okay, so I'm going to pause the recording, give you a few minutes, try to fill in the income statement and calculate the net income. Okay, so chapter 3, problem 2. The product sells for $450 per unit. Variable costs per unit are $200. And there are fixed costs of $40,000 a month. So we're dealing with just 1 month worth of data. In May, the company sold 225 bikes. All right, so that was our basic information. First thing we have to do is figure out contribution margin per unit. So what is our sales price?
450.
What is our variable cost per unit?
200.
And so what is our contribution margin per unit?
250.
Okay, everybody agree with that? That wasn't so bad. Okay, B, contribution margin per unit, we just said is $250, right? And our selling price per unit, we said was $450, right?
Mhm.
So what is our contribution margin ratio?
0.56.
What was that?
0.5 repeating, but 0.56.
Is that right? Okay, 0.56. Jeff. It's not calculator. Not that I doubt you all. I really don't. So we have contribution margin per unit divided by sales price per unit, 0.56. Okay, so we can, that was a pretty long number there, so we could round it off to 0.56. Very good. Then contribution margin income statement for May. So again, we were told we sold 225 units. You can multiply that by the $450 sales price. We get our total revenue, $101,250. Right? Then our variable costs are $200 per unit. Multiply that by the 200 we sold. $45,000 of variable costs. How do we get our contribution margin?
Subtract the cost from the sales.
Correct, exactly. So sales minus variable costs. 56,250. That look right so far? Fixed costs, they told us are 40,000. And what would be our net income?
16,250.
16,250. Okay, so let's check that. And this was problem 3, right? Problem 2. And okay, the textbook rounds to 56%. You can, if you want, you can change it, but if you leave it at, what did I say? Did I say 0.56? Oh, we said 0.56. Okay, so same thing. All right, and then 16,250 is right. So you got that right. Okay, that wasn't so bad. Any questions on that problem? Robert?
For the income statement, why does it say loss next to net income? If we made more?
Because it could be either.
Okay.
In this case, it's an income, but if we've gotten a negative number, we would know
okay.
it'd be a loss. Right?
So it's income or loss.
Yeah.
Okay.
Any other questions? Okay, well, I think that's a good stopping point. So you get a little bit longer break. I'll come back at 2:50.